Welcome to The Explainer. Today, we're cutting right through the social media noise. The leased Lamborghinis and those viral finance gurus, to look at something genuinely fascinating. We're diving into the surprisingly boring structural reality of how real, audited millionaires actually build and keep their wealth. Seriously, throw out everything you've seen on your feed. The truth is way more structural, and honestly, it's a lot more achievable for us. Here's the blueprint we're running through today. We're going to unmask the wealth myth, break down the inverse complexity rule, look at the actual habits of the wealthy, dive into the psychology of money, and finally, map out the wealth velocity path. Let's kick things off with part 1, unmasking the wealth myth. Myth versus reality. We're starting right at the absolute foundation. When analysts literally open up and dissect the bank accounts of hundreds of real-life millionaires, a super distinct pattern jumps out. True wealth? It is not built on speculative frenzies, hyper-complex trading algorithms, or exotic crypto bets. It definitely doesn't rely on getting lucky. Instead, it comes down to highly disciplined and, honestly, incredibly boring structural habits and mental frameworks. It completely flips all that standard internet get-rich-quick advice totally on its head. Moving right along to part 2, the inverse complexity rule and the core asset breakdown. So how exactly does this disciplined mindset translate into what they actually own? Well, it boils down to this fascinating concept called the inverse complexity rule. Basically, it means that as a person's wealth goes up, the complexity of their daily investment portfolio actually goes down. Think about that for a second. Self-made millionaires are not sitting there juggling dozens of single stocks across 6 glowing monitors trying to outsmart Wall Street before breakfast. Actually, scratch that. It's the exact opposite. The richest people almost always have the simplest portfolios. When we peek into the core asset buckets of these high net worth accounts, the breakdown is shockingly straightforward. We're talking capital split roughly like this. About 35% in equities, 30% in real estate, 20% in private equity and business, and a solid 15% in cash and equivalents. They are heavily weighting simple index funds like your standard S&P 500 and real estate, and then just stepping back to let compound interest do the heavy lifting. It is aggressively unexciting. But hey, that's exactly why it works. Peeling back the layers on these buckets, you start to see a strategy built on absolute clarity. For equities, they skip the speculative stock picking entirely and just buy simple index funds. For real estate, it's mostly primary long-term residences and boring income-producing properties. And look at the cash. They keep really robust buffers in treasury bills or high-yield accounts. Why? Specifically so they have dry powder to buy when the market inevitably drops. As for private equity, they only risk their money on ownership stakes in businesses they understand inside and out. The whole thing is basically a masterclass in avoiding unforced errors. Okay, part 3. Let's look at the habits of the wealthy and their operational systems. There is this massive, glaring gap in how they handle daily operations. Because, accumulating wealth is rarely about that top-line number of how much you make. It is all about the gap you maintain between your income and your lifestyle. Just think about how most people handle execution. Do you rely on manual savings at the end of the month? Well, the wealthy definitely don't do that. They automate their investments. The money gets pulled before the everyday checking account is ever even touched. Meanwhile, the average consumer tries to save whatever cash happens to be left over at the end of the month, which, let's be real, is usually zero. And get this, look at how they capture knowledge. 88% of these audited millionaires are reading for at least 30 minutes every single day to sharpen their skills. Compare that to the endless passive entertainment the average person is scrolling through. Just to put a specific point on how they battle lifestyle creep, take a look at this number, 64%. A whopping 64% of these audited millionaires practice what we call conscious frugality. They live in modest homes. On top of that, over 55% deliberately buy reliable used vehicles. No leased luxury SUVs here. They just flat out refuse to play the hyper-consumption game. When their income goes up, their lifestyle absolutely does not automatically rise with it. And when it comes to managing risk, the millionaire approach relies strictly on asymmetric bets. By that, I mean situations where the potential upside just vastly outweighs any downside risk. They only put capital on the line that they can completely afford to lose. And interestingly enough, 84% of them never even gamble. They entirely sidestep those speculative, FOMO-driven frenzies. That fear of missing out that the average consumer always seems to blindly chase during those short-term hype cycles. That brings us to part 4, the psychology of money and the necessary mental shift. Assets and habits are great for the structural foundation, sure, but they will completely collapse if you don't make the right mental shifts. Author Morgan Housel really hit the nail on the head with this. He says, doing well with money has little to do with how smart you are and a lot to do with how you behave. We absolutely have to understand this point. Building true wealth, it is not an IQ test. It is fundamentally a daily ongoing test of your behavioral regulation. So there's this ultimate psychological divide that the wealthy figure out really early on. It's the stark difference between being rich and being wealthy. Being rich requires spending your money just to display visual cues, right? It's the high current income, the leased sports car, the flashy luxury watch, the designer wardrobe. It literally takes money to show people that you have money. But being wealthy? That is the exact opposite. Wealth is practically invisible. It's the unspent assets, the hidden security, those quiet index funds that haven't been cashed out to buy physical stuff. Wealth doesn't give you shiny objects, it gives you profound options. And having those options leads directly to this idea, autonomy as the ultimate dividend. The truly wealthy understand that the absolute highest value of a big bank balance isn't buying heavier or shinier objects. No, it's about acquiring complete autonomy over your own time. It's buying the freedom to choose exactly what work you do, who you choose to do it with, and when you wake up every single morning. Honestly, that is the ultimate flex. They also master emotional regulation over intellectual complexity. When the markets suddenly drop 20% or the economy turns negative, average investors go into full-blown panic mode, right? They frequently end up selling off their assets at the absolute bottom. But the wealthy? They just don't panic. They calmly look at market volatility as simply the required price of admission for those outsized long-term gains. They never see it as a fine or a penalty. All right, let's move into our final section, part 5, the wealth velocity path and the timeline to wealth. So, how does all of this actually map out over a person's life? This financial journey definitely does not happen overnight. It generally unfolds across 3 distinct phases. You've got years 1 through 10, which is the aggressive accumulation phase. Then, years 10 through 20 is the compounding transition. And finally, year 20 and beyond is what we call the preservation and simplification phase. Notice how their entire strategy fundamentally shifts over time. Back in that accumulation phase, you're essentially manually feeding the investment engine. You're focusing purely on raw income generation and just maximizing that critical gap between what you earn and what you spent. Then you hit the transition phase. This is where you shift focus from just manually saving cash over to asset performance. You're letting your portfolio literally out-earn your daily labor. And finally, once you reach the preservation phase, you de-risk. You step away from anything volatile and shift heavily into super diversified index funds, real estate, and cash to guarantee that generational durability. So, as we wrap up this explainer, I really want to leave you with a pivotal question. And this is based on the actual audited reality of self-made millionaires. Take a hard look at your own habits right now. Are you going to spend your hard-earned resources trying to look rich just to impress strangers? Or are you going to embrace the beautiful, totally boring discipline required to build invisible wealth? The choice, and really the entire architecture of your future, is totally up to you.